This is a BC Eagle Finance video. Brigham and Houston Chapter 3, Financial Statements, Cash Flow, and Taxes. A review of all of these. Here is a review of the contents of Chapter 3. What are in the financial statements and what do they report? And then a little bit more detail about the balance sheet, the income statement, the statement of cash flows, and the statement of shareholders' equity. Points 3.2 through 3.5 show the four types of financial statements that you can get in any company's annual report. This chapter also reviews the uses and limitations of financial statements and a statement called free cash flow that's not part of the report, but financial analysts calculate this because of their emphasis on cash flow. Financial analysts use cash flow as a basis for all of their evaluation. Section 8 distinguishes between market value added, which is comprised of the difference between the value that the stock market places on the financials or the assets of the corporation and the value that the corporation paid to get those assets in the first place. Economic value added is a new concept that addresses one drawback that financial statements have, and that is the financing cost for all sources of capital. Financial statements only show the cost of debt capital, interest, but do not show any cost of equity capital, stock. EVA, economic value added, is designed to correct that. And the last topic deals with income taxes. The chapter gives a very quick overview of individual income taxes and corporate income taxes, and we will include a brief review of some of the changes of the 2017 Tax Cut and Jobs Act. Now, I'm going to ask that you guys start a discussion using Canvas for these questions. What is an annual report and what types of information does it provide? And as a way to start this conversation, download and review Netflix Annual Report. Using that report, can you identify the types of information annual reports provide? Secondly, what are the four financial statements and what do each of those statements tell potential providers of capital? And finally, why is the annual report of such great interest to investors? Learning objective number 2, the balance sheet. This is the format of a typical balance sheet. Typical balance sheet is divided into its left-hand side and right-hand side. Left-hand side shows the left-hand side shows the resources that the company uses to earn revenue, and the right side shows the three financing sources: debt, contributed capital common stock, and earned capital retained earnings. Also, the balance sheet is split between top and bottom portions. The top portion, which has the current assets of cash, accounts receivable, and inventory, and the current liabilities of accrued wages and taxes, accounts payable, and notes payable, are considered part of operating activities. Current assets and current liabilities come about because of the accrual process that accountants use to record revenue. And so they are not considered pure financing or investing activities. They are considered part of the operating activities of a business. Moving to the long-term asset side, these represent the investing activities of a business. A business may invest in new plant and equipment, and a business may invest in other long-term assets like long-term investments of financial nature, and they may even buy other companies, which would be shown as an investment as a long-term asset. Long-term debt, as the name suggests, is long-term financing that may go as long as 40 years. Common stock represents the issue of ownership rights to individuals in exchange for their cash in an initial public offering. And retained earnings represents all the income that the company has earned in the past and has not distributed to its owners as dividends. Now, let's take a look at a particular balance sheet that was used in your chapter, Table 3.1, the Allied Food Products Corporation. Now, as you see, this balance sheet is comparable in its nature. It shows 2 years, and the Financial Accounting Standards Board requires that all financial annual reports show at least 2 years of financial information. The current assets are listed first, and those are usually compared to the current liabilities. Following the current assets would be the plant, property, and equipment, and following the current liabilities would be the long-term financing, any bonds, common stock, and retained earnings. The thing to note is that the balance sheet gets its name because the total assets will equal the total of the liabilities plus the total of the equity. Learning objective number 3, the income statement. Again, let's look at the Allied Food Products Company for the year ended December 31st for 2016 and 2015. The income statement shows the results of operations, the income that has been earned from using the assets that the company has purchased. The income statement has 5 functional areas. The first functional area is the gross profit. Net sales less the cost of goods sold gives the gross profit. Profit before considering any operating expenses. The second area or functional area of the income statement would be the operating costs, and those would be the selling, general, and administrative costs necessary to run the assets. An additional operating cost would be any depreciation or amortization associated with the wearing out of physical assets. Gross profit less the operating costs gives something called EBIT, earnings before interest and taxes. You learned this as operating income in Principles of Accounting. Operating income or EBIT less the interest, this is the third area, the financing costs shown on the income statement. A note to take, the income statement only shows interest or the cost of debt. The income statement does not show the cost of equity, which would be the dividends. Dividends are considered to be a distribution of net income and not an expense in the determination of net income. EBIT less interest gives you earnings before tax. Less tax gives you the net income. In addition, near the income statement, the total dividends might be disclosed, and if we would take the net income less total dividends, that would represent the increase in the retained earnings balance. Retained earnings represents income that has been earned in the past by the corporation but has not yet been paid out or distributed to owners in the form of dividends. Also, income statements will show some type of supplementary information like the common stock price, the earnings per share, which is the net income divided by the number of shares that the company has outstanding, the dividends per share, and something called the book value per share. Book value per share would be the owner's equity, common stock and retained earnings, divided by the number of shares. The book value per share shows if the company would go bankrupt and if all the assets could be sold for at least what they were purchased for, this would be the distribution in liquidation that investors would get. Here are some Canvas discussion questions that you guys can work on. Why is the earnings per share called the bottom line, and what is EBIT or operating income? What is EBITDA, earnings before interest, taxes, depreciation, and amortization, and what special information does that EBITDA value provide to the providers of capital? Providers of capital would be lenders, debt, and contributed capital, stock. Which is more like a snapshot of the firm's operations, the balance sheet or the income statement? And why would that be the case? This is the end of video number 1 for Chapter 3. Thank you for listening.